Hi, welcome to this tutorial on cryptocurrency and blockchain. We're going to be talking about the 8 rules of cryptocurrency investing, and this tutorial is about knowing your risk profile, rule number 1. Okay, so this is going to be a playlist or series that will cover 8 rules of cryptocurrency investing. As I just said, this one's about knowing your risk profile. Then we're going to have later tutorials about there is no easy way to make millions quickly, that you need to understand the market or space and what you're investing in. Number 4, that you need to secure your assets, use security precautions, and skill up tech-wise. Rule number 5 is that things will break and things will change quickly in the cryptocurrency space. Rule number 6, be prepared for extreme volatility. Rule number 7, don't outsource your own research and be wary of experts and gurus in the cryptocurrency space, including myself. And it will finish with the capstone tutorial, rule number 8, the principles of investments still hold. Okay, since this is about financial services, let's just go through a disclaimer. The business Accofina and myself, the individual, are not giving personal advice in this video. It is meant to provide factual information for educational purposes. We do not know your personal circumstances and financial goals. This is general information only and should not be taken as constituting professional advice. You should seek independent, legal, financial, taxation, or other advice to check how this information relates to your unique circumstances before taking or not taking any actions. Accofina and myself are not liable for any loss caused, whether due to negligence or otherwise arising from the use of or reliance on the information provided directly or indirectly by this video. Okay, let's get into this tutorial. Rule number 1 of cryptocurrency investing: know your risk profile. So what is a risk profile in the first place? It is your unique investor personality. It helps you manage risk while targeting your return, and it does this through diversification. What we're saying here is that your unique risk profile will determine your portfolio asset allocation. Now, what's a portfolio asset allocation? It's how you allocate your total assets between the various asset classes. Now, the standard asset classes are cash, fixed interest or bonds, property, stocks, and alternatives. And your asset allocation is the percentage or proportions between these asset classes. So how does risk profiling and cryptocurrency fit together? Well, what we would say is that cryptocurrency would fall in the alternative investment asset class. Now, the alternative investment asset class is characterized by a specialization of managers, experts, and community. That is, that the people working within this particular asset class are normally only in this asset class. Their knowledge is based in this particular asset class and doesn't transfer or overlap with the other asset classes. This is quite unique in regards to alternative investments. So, for instance, if you're an art dealer and artwork is an alternative investment, then you're probably only a specialist in the artwork space. You don't normally say, well, I'm an expert in artwork, but I'm also an expert in equities. Secondly, returns are not correlated with traditional investments. And this is why alternative investments are often added to portfolios. Is that many of the other asset classes are either negatively correlated or positively correlated. Alternative investments are normally all over the place, so they can kind of add some good diversification benefits when they're not correlated at all with the other traditional investment classes. Thirdly, there's less regulation and less transparency in alternative investments. You'll see that there hasn't been the long history and government regulation and community behind it to create the more standardized rules and open transparency and governance principles that we have with some of the traditional assets. Similar to this, there may be limited or spotty historical data. Because these assets are less popular and less well known as some of the other asset classes, there aren't the same level of firms and services providing or collating historical data. So if you can get access to data, it's often harder. It may just be a little bit spotty and not as in-depth and dense as some of the other asset classes' historical data. And again, because of their specialization, there are unique legal and tax implications. So I've given some examples of the characteristics. Where do these kind of apply in the real world? So some of the other alternative assets, aside from cryptocurrency, would be commodities, if you invest in commodities like agriculture or precious metals and so forth. Or if you invest in venture capital or LBOs, which is leveraged buyouts. And these are both types of private equity investments. Also, hedge funds are considered alternative investments. If you invest in infrastructure, such as investing in railroads or electricity assets or even highways and so forth, they're considered alternative investments. And finally, as mentioned earlier, artworks, antiques and rare coins can all be valid investments and are considered part of the alternative investment asset class. Alright, so let's get back to risk profiles. Now, it's generally considered that there are 5 standard risk profiles. Now, these can vary a bit how they're termed. There can often be 6 or 4 standard risk profiles, but I'm going with 5 with some of the most common names. Now, you can be a conservative investor or a defensive investor. Secondly, if you want a little bit more risk, then you could be a moderate investor. If you're kind of in the middle in regards to your risk profile, you may be a balanced investor. And also you could be looking for growth or a growth investor if you're quite risk tolerant. And finally, you can be an aggressive investor or have a high growth risk profile. And that's where you have more of your assets in the aggressive asset classes. So does this make sense? Depending on your unique risk profile, whether it's one of those 5 or a little bit overlapping or one of your own, you will spread or allocate your portfolio across asset classes at particular percentages per class. So let's have an example here. A conservative investor may have 50% of their holdings in cash, 25% in fixed interest or bonds, 20% in property, and 5%, if I've done my sums correctly, in stocks. And that would be a very conservative asset allocation and risk profile. Now, a high growth or aggressive risk profile might lead you holding perhaps 60% in stocks, 20% in property, no cash, 10% in bonds, and 10% in alternative investments. And that's just an example of how different risk profiles have different portfolio allocations. So your risk profile is based on your risk tolerance and risk capacity. They're the 2 key components. Now, risk tolerance is your mental attitude to volatility and losses of your investments. And here's a colloquial example. Like, are you going to lose it and start acting irrationally if markets swing wildly? So if the markets drop by 10% or 15% over a day or a week or so, are you going to find that very, very difficult to handle? Are you going to be panicky, irrational, start selling things crazily, and basically have a pretty difficult time to keep yourself calm? In that case, your risk tolerance would be low. Now, if you're more comfortable with wild swings and perhaps less concerned about short-term outcomes and have a long-term plan in place that you're confident in, then you might be able to handle more wild swings in the short term, and in that case, your risk tolerance would be high. And it's important to note that your risk tolerance does change over time and with experience. So in regards to cryptocurrency and my personal experience, when I first invested in cryptocurrency, my risk tolerance was quite low. I wasn't sure about this space. I wasn't sure whether it was a good investment or how risky it was. But as I've become more comfortable over time and had more experience doing the investments and holding them and watching the market move and so forth, then my risk tolerance has increased as I've become more comfortable over time and with experience. So it's not fixed. It does change over time and with experience. Now, secondly, is your risk capacity. Now, this is your financial ability to absorb losses. So, for example, if this investment blows up, are you going to lose your house, your shirt, and ability to feed yourself and your family? And again, I'll use an example here. I'll introduce myself. My risk capacity to lose $10,000 on an Ethereum investment is very different to Jeff Bezos's or Bill Gates' risk capacity to lose $10,000 on Ethereum. So we have different risk capacities because we have different abilities about absorbing particular losses. So that can determine your risk capacity. And once again, risk capacity can change over time. In this situation, it's with life stages and particular circumstances. So while at one point in time, you may have high risk capacity because you have no upcoming expenses and you see your life stage is pretty stable with no real changes in the horizon, suddenly you find out that you're going to have a baby or your partner's going to have a baby, and suddenly your risk capacity lowers. Now you need that extra cash to plan for the different circumstances with your new family. So different life stages, particular circumstances, even if you're going for a holiday, if you're planning to go for a holiday or buy a house, then your risk capacity can change in that case. Suddenly you can't wait for 20 years for your investments to pay off. You realize you're going to have to liquidate some assets in the near term, so your risk capacity will lower. All right. So how does risk tolerance and risk capacity apply to cryptocurrency markets? So let's look at the risk spectrum of the different assets we can invest in. Now, cash is considered the safest and least risky. Then we move up to fixed interest or bonds. They're the same thing, they're just different terminology. They're considered more risky than cash, but still quite safe. Following that, we move up the scale further along, we have property investments. And finally, at the top of the scale, we have stocks. Now, only after these 1, 2, 3, 4, then we have 5 and some other alternative investments. Now, crypto assets may not even be 5, they may be 15 up the spectrum, because what you'll find is that cryptocurrency investing is highly speculative. It's very aggressive. After all, cryptocurrency is an emerging asset class with a short history. The regulation is little to non-existent. The short history means there aren't very many experts in the field. There's not a lot of data to do quantitative analysis to work out what's going on. The financial infrastructure and intermediaries are non-existent or still just startup firms. It's a highly volatile market. So even in just the past week, over a couple of days, the market fell about 8 to 10%. Now that would be extreme if it was applied to equities. Losses of that size, something we last saw in the GFC 10 years ago. Now with cryptocurrency, those sorts of falls occur maybe 3, 4, 5 times a year. It's a highly volatile market, both up and down. And generally, cryptocurrency assets pay no income. So while some investors can handle wild swings, handle volatility, if they have a long-term plan and are collecting dividends or interest or income along the way. Cryptocurrency assets generally don't pay income. Some do, but the large majority don't. Alright, so in conclusion, before deciding if, how much, and what percentage of your portfolio to allocate to cryptocurrency, it's important that you go in with your eyes wide open about the market and the unique skills needed. These types of investments will be different to any stock investments or any FX investments or any bond investments you've previously made. There are particular skills you will need. There is terminology that don't cross into other asset classes. It is very unique and you have to go in there with your eyes wide open. You'll have to know how you'll be able to sleep at night considering the volatility. Now, just the example I gave in the last couple of minutes. Can you handle perhaps going a week or two and having a large portion of your crypto assets jump up and down or fall off a cliff? If you're not going to have a very enjoyable time living life, then it might not be ideal getting involved in this space. You have to know whether you can handle the volatility. And very, very importantly, don't risk more than you can afford to lose. Now, lots of people say this when it comes to the crypto space, but in more technical terms, it's about using a reasonable portfolio allocation for an emerging alternative asset class. The idea is that if you look at it as an emerging alternative asset class, what would that normally represent as part of your portfolio? It shouldn't be 100%, but should it be 0? It's important to consider your entire portfolio. And then you'll be able to better assess what you can afford to lose within the whole portfolio and not just this particular class. And here's the final conclusion. Okay, that's fireworks. All right, investing in cryptocurrency is not a binary yes or no decision, nor a one-size-fits-all decision. You don't simply listen to people saying, no, don't get involved in that asset class. And at the same time, don't believe the people that say, yes, come on, this is great, you should get in on it. It's not simply yes or no, nor is it one size fits all. So what may work for one person might not necessarily work for you, which again might not necessarily work for someone else, your brother or your sister or someone in your family. The idea is it involves assessing your unique and individual risk profile. And that's what this tutorial is about. How does cryptocurrency investing fit into your risk profile? And from there you determine what percentage of your portfolio, if any. And again, this type of investing isn't for everyone to allocate to this class. And that's the conclusion. It's not a binary yes or no, and what's good for one person isn't necessarily good for all other people. Alright, so let's wrap up. What do we cover? What is a risk profile? This is your unique investor personality that helps determine your asset allocation. How does risk profiling and cryptocurrency fit together? Cryptocurrency is within the alternative investment asset class. So we talked about standard risk profiles from conservative and defensive all the way through to high growth and aggressive. We talked what made up your risk profile, and that was your risk tolerance and risk capacity. Your tolerance is your mental attitude to risk, and capacity is your financial strength to absorb risks. We talked about how risk tolerance and capacity apply to cryptocurrency markets, and that cryptocurrency markets are at the extreme end of the risk spectrum and are considered highly aggressive investments. And then we had our conclusion that cryptocurrency investing isn't a binary yes or no decision, nor a one-size-fits-all decision, in that it should only form part of a well-managed portfolio, and whatever you decide is individual to your own unique investor profile. Okay, that's it. I hope this helped. Best of success. If you enjoyed the video, please subscribe to the channel. Click on the button that will soon appear. Or you can watch another one of my tutorials now. Or if you don't want to do either of those, I'd really just appreciate it if you gave this video a like. Finally, feel free to comment below if anything needs clarification, or if you want to just say hello. Thank you very much for your time, and that is it.